There's a number that appears in every headline, every news report, every quarterly earnings call. It's the number that sends stocks soaring or sends them crashing down. It's called net income, or earnings per share. It is the official, audited, legally sanctioned measure of a company's success. And for the vast majority of investors, it is the absolute truth. They anchor their hopes, their dreams, and their life savings to this single figure. Yet, one of the wealthiest men in human history, a man who built an empire the size of a nation on the bedrock of financial analysis, has a different view. Warren Buffett believes that in many cases this number isn't just a distraction. He believes it's a lie. Not necessarily a fraudulent lie, but a lie of omission, a funhouse mirror that distorts reality. He knows that net income is an opinion, a carefully constructed narrative shaped by accounting conventions, while cash is a fact. This is the story of Buffett's single greatest trick, a mental model so powerful it can cleave a company's financial statements in two, separating the accounting fiction from the economic reality. It's a principle called owner earnings. Mastering it is the final promise of clarity in a market deliberately designed to confuse you. It prevents the single most costly mistake an investor can make: buying a company that looks profitable on paper, but is, in reality, a ravenous machine that burns cash just to stay alive. By the end of our journey today, you will no longer see corporate profits as a number to be trusted, but as a claim to be investigated. You will learn to perform the exact calculation Buffett uses to find a company's true cash profit, allowing you to sidestep the traps that ensnare 99% of market participants and invest only in the genuine, cash-producing engines that build lasting, generational wealth. The world of corporate finance is littered with ghosts, the spectral remains of companies that once seemed invincible. They were darlings of Wall Street, their stock charts a beautiful, uninterrupted climb to the heavens. Their chief executives graced the covers of magazines, hailed as visionaries, as titans of industry, and their net income, their reported profits, were immaculate. One of the most haunting of these ghosts is a company called Sunbeam, and its story serves as the perfect foundational anecdote for understanding why the official numbers can be so dangerously misleading. In the mid-1990s, Sunbeam was a sleepy, unremarkable maker of household appliances: blenders, toasters, electric blankets. It was a business, but it wasn't an exciting one. Then, in 1996, the board made a decision that would catapult the company into the stratosphere and then, just as quickly, into the abyss. They hired a man named Albert J. Dunlap, better known by his terrifyingly efficient nickname, Chainsaw Al. Dunlap was a celebrity CEO, a corporate turnaround artist with a brutal reputation. His playbook was simple and savage. He'd come into a struggling company, fire thousands of employees, close factories, and slash costs to the bone. Wall Street loved him. He was seen as a shareholders' champion, a man who could take any bloated behemoth and squeeze out profits. When he took the helm at Sunbeam, the stock shot up nearly 50% in a single day. Investors were betting on the magic of Chainsaw Al, and for a while it seemed their bets were paying off spectacularly. The reported earnings under Dunlap's tenure were nothing short of miraculous. Quarter after quarter, Sunbeam didn't just meet Wall Street's expectations, it shattered them. Net income soared. The stock price followed, rising from around $12 a share when he was hired to over $50 a share at its peak. Analysts wrote glowing reports. Financial news networks paraded Dunlap as a genius. He even wrote a book, shamelessly titled Mean Business. He was the embodiment of the successful, hard-charging CEO, and the numbers seemed to prove it. Investors who simply looked at the headline earnings per share saw a company in the throes of an incredible renaissance. They saw a growth story, a profit machine firing on all cylinders. But beneath the surface of that beautiful income statement, a cancer was growing. The profits weren't real. They were an accounting mirage. Dunlap was a master, not of business operations, but of financial manipulation. He was using every trick in the accounting playbook to pull future sales into the present and to hide costs, creating the illusion of profitability. One of his favorite techniques was something called channel stuffing. He offered massive discounts to retailers like Walmart and Kmart to buy huge quantities of products, like barbecue grills, months before they would actually need them. Sunbeam would book the revenue for these sales immediately, making the current quarter's net income look fantastic. The problem, of course, was that these retailers now had warehouses full of Sunbeam grills. They wouldn't need to order any more for the next 6 months, or even a year. Dunlap had stolen sales from the future to make the present look good. He was creating a massive, unseen hole in the company's future earnings power. Simultaneously, he used cookie jar reserves. When he first took over, he took a massive one-time charge, a restructuring charge, claiming it was to cover the costs of all the firings and factory closures. But he deliberately overestimated this charge, creating a secret slush fund, a cookie jar. In later quarters, when profits were looking a little thin, his accountants would dip into this jar, releasing some of those reserves back into the income statement as a reduction in expenses, artificially boosting net income. On paper, it was a work of art. The income statement, the document everyone was watching, was pristine. But the cash told a different story. While net income was climbing, the company's actual cash flow from operations was struggling. The accounts receivable were ballooning because retailers who had been stuffed with products weren't paying their bills yet. Inventories were a mess. The company wasn't generating real money, it was playing a shell game with accounting entries. In 1998, the game finally fell apart. The future that Dunlap had borrowed from arrived, and it was empty. Retailers stopped ordering, the sales dried up, and the beautiful net income numbers turned into horrifying losses. The stock collapsed, wiping out billions of dollars in shareholder value. Dunlap was fired, the company went into bankruptcy, and the Securities and Exchange Commission charged him with massive accounting fraud. The investors who had trusted the headlines, who had believed in the beautiful lie of net income, were left with nothing. Their costly mistake was not a failure of intelligence, but a failure of focus. They were reading the wrong chapter of the book. They were mesmerized by the opinion, and they ignored the fact. This catastrophic failure is the starkest possible illustration of the principle. A company's reported profit is not the same as its ability to generate cash. And it is the cash, and only the cash, that can ultimately pay you, the owner. The reason so many intelligent people, from retail investors to seasoned professionals, fell for the trap at Sunbeam and countless other companies can be explained by a powerful set of underlying psychological principles. Our brains are wired with cognitive shortcuts, ancient survival mechanisms that serve us well in the wild, but can be disastrous in the world of financial analysis. The first and most potent of these biases is the anchoring bias. When we are presented with a piece of information, especially a number, our minds tend to latch onto it, or anchor to it, and we interpret all subsequent information in relation to that initial anchor. In investing, the most prominent anchor is earnings per share, or EPS. It's the number plastered across every news ticker, the headline of every press release. Company X reports record earnings, beats estimates by 5 cents. This number is delivered with an air of finality and authority. It becomes the unquestioned starting point for almost all analysis. Because our brains are anchored to this official profit number, we are psychologically predisposed to believe it is the most important metric. We frame our entire perception of the company's health around it. When someone later presents evidence that cash flow is weak or that accounting games are being played, it feels like an attack on the established truth. We have to work hard to dislodge that initial anchor, and most people simply don't have the time, training, or inclination to do so. They see the anchor, they accept the anchor, and they make their investment decision based on it. Coupled with the anchoring bias is the authority bias. We are socially conditioned to trust figures of authority and official-looking documents. A company's income statement is prepared by accountants, audited by a major accounting firm, and signed off by the CEO and CFO. It is filed with a government agency, the SEC. Everything about it screams official and trustworthy. When a CEO like Al Dunlap, a man lauded by Wall Street and featured in the most respected financial publications, presents a set of stellar earnings, our natural inclination is to believe him. He is the authority figure. The audited financial statements are the authoritative documents. To question them feels like questioning the entire system. It feels contrarian, difficult, and even a little paranoid. This psychological tendency to defer to authority makes investors passive recipients of information rather than active investigators of it. They accept the numbers presented to them without asking the crucial follow-up questions. How was this number constructed? What assumptions were made? What non-cash items are inflating it? What necessary cash expenditures are being ignored? The system is designed to make you a consumer of the net income number, not a forensic accountant who deconstructs it. The path of least resistance, the one our brains are wired to take, is to simply trust the experts and the official reports. This is precisely the vulnerability that manipulators like Dunlap exploit. They understand that if they can make the official authoritative number look good, the vast majority of people will never bother to look behind the curtain. The third cognitive bias at play is what can be called narrative-driven thinking. Humans don't process the world in spreadsheets. We process it in stories. A simple, compelling story is infinitely more persuasive than a complex set of data. Turnaround genius comes to sleepy company, slashes costs, and creates a profit machine is a powerful, easily understood narrative. It's a story of success, of decisive action, of wealth creation. This story, promoted by the company and amplified by the media, becomes the lens through which all data is viewed. The soaring net income figures are not just numbers. They are plot points that confirm the heroic narrative. Investors get caught up in the story, and their critical thinking faculties are diminished. They want the story to be true because it's exciting and profitable. This desire makes them susceptible to confirmation bias, where they actively seek out information that supports the narrative, like a rising stock price, and ignore information that contradicts it, like a deteriorating cash flow statement. Focusing on owner earnings, as we will learn to do, is a direct antidote to this narrative-driven thinking. It is a cold, hard, storyless calculation. It doesn't care about a charismatic CEO or a compelling turnaround story. It asks one brutal, unemotional question. After all the accounting games are stripped away and after the company makes the necessary investments just to keep its existing business alive, how much cash is left over for the owners? This question cuts through the narrative and anchors you to economic reality. It replaces a seductive story with an indisputable fact, protecting you from the psychological biases that lead the herd astray. To navigate this minefield of accounting fictions and psychological traps, we need a practical instruction manual, an applied mental model that we can use every time we look at a potential investment. Let's call this model the accountant's opinion versus the owner's reality. It's a blueprint for transforming yourself from a passive consumer of financial news into a skeptical business analyst. The goal is to retrain your brain to see net income not as the final answer, but as the opening statement in a long and complex negotiation. Step 1 of this model is to invert your process. Most investors start with the income statement. They look at revenue, they look at expenses, and they arrive at the bottom line, net income. You will do the opposite. You will start by acknowledging the net income number, but you will immediately put it aside and go straight to the statement of cash flows. This is a profound shift in due diligence. The income statement is where the story is told. The cash flow statement is where the truth is revealed. This simple act of changing the order in which you read the financial statements begins to break the anchor of net income. You are choosing to start with the facts, cash, before you listen to the opinion, earnings. Step 2 is to perform what we'll call a non-cash audit on the net income figure. Inside the statement of cash flows, the very first section, cash flow from operating activities, does this for you. It starts with net income and then adds back all the non-cash expenses that were used to calculate it. The biggest and most famous of these is depreciation and amortization. Depreciation is an accountant's best guess about how much a company's assets have worn out over a period. It's a legitimate and necessary expense on the income statement, but crucially, no cash actually leaves the building. The company doesn't write a check to Mr. Depreciation, so to get closer to cash reality, we must add this non-cash charge back to net income. Other non-cash items like stock-based compensation also get added back. This is the first half of the journey from the accountant's opinion to the owner's reality. We have taken the official profit number and corrected it for all the expenses that didn't actually involve spending cash. We are now at a number often called operating cash flow, which is a much healthier metric than net income, but our work is not yet done. This is where most analysis stops, but it's where the true Buffett-style analysis begins. Step 3 is the most critical and most overlooked piece of the puzzle. It's the necessary cash outlay investigation. After we've added back the non-cash expenses, we must now subtract the very real cash expenses that are required to keep the business running but are not included on the income statement. This crucial expense is called maintenance capital expenditures, or maintenance CapEx. Capital expenditures are cash payments for long-term assets, like building a new factory, buying new machinery, or upgrading a computer network. These are not expensed on the income statement. Instead, they are capitalized on the balance sheet, and then slowly dripped into the income statement over many years as depreciation. However, the cash for that new factory is gone instead this year. It has left the owner's pockets. The key is to distinguish between two types of CapEx: growth CapEx, which is spending to expand the business, like building a second factory, and maintenance CapEx, which is spending just to maintain the current level of business, like replacing the leaky roof on the first factory. A business must spend its maintenance CapEx just to stay in the same place. It's the cost of running on the corporate treadmill. This cash is not available to the owners. It is not profit. Therefore, we must subtract this amount from our operating cash flow figure. This final number, net income plus depreciation minus maintenance capital expenditures, is the owner's reality. It is owner earnings. This three-step process, invert, audit, investigate, is the blueprint. It takes you from the headline number to the cash in the vault. It is the core discipline of a professional capital allocator, the essential tool for any entrepreneur or CEO who wants to understand the true financial health of their own business or that of a competitor. To fully appreciate the power of this mental model, we must dedicate some time to exploring the opposite approach, the path of the 99%. This is the path of the headline investor, the momentum chaser, the person who believes that corporate profits are a simple, trustworthy number. Their journey is one of convenience, cognitive ease, and, all too often, financial disaster. The quintessential member of this group is what we might call the earnings season gambler. Twice a year, Wall Street becomes obsessed with earnings season. For weeks, the entire conversation revolves around two questions. Did the company beat expectations? And what is their guidance for next quarter? The earnings season gambler lives in this world. Their financial analysis consists of looking up the consensus analyst estimate for a company's earnings per share. If the company reports a number that is even a penny higher, they call it a beat, and they buy the stock. If it's a penny lower, they call it a miss, and they sell. They have outsourced their thinking entirely to a group of analysts, and have reduced the complex reality of a multi-billion-dollar enterprise to a single, binary outcome. They are not investing in a business. They are betting on a number. They have no idea how that number was constructed. They have not read the financial statements. They certainly have no concept of owner earnings. They are simply reacting to the headline, caught in a Pavlovian response to the media narrative. This behavior is incredibly common, and it's a recipe for failure. Consider a hypothetical software-as-a-service company, Cloud Corp. Cloud Corp reports quarterly earnings and announces an EPS of $1.05, beating the analyst estimate of $1. The stock jumps 15% in after-hours trading. The earnings season gambler sees the headline, feels the thrill of being right, and buys more shares. But let's look under the hood. In their financial statements, you find that a huge portion of their expenses is stock-based compensation for their engineers and executives. This is a non-cash expense. They are essentially paying their employees by printing new shares of stock, diluting the ownership of existing shareholders. On the income statement, this looks fine, and it helps them beat the EPS number. Furthermore, let's say Cloud Corp is spending a fortune on new data centers just to keep up with customer demand and prevent their service from crashing. This is a massive cash outlay, a huge capital expenditure. Because much of it is considered maintenance CapEx, the cost of simply serving their current customers, it represents a real drain on the cash available to owners. When you apply the owner earnings calculation, you might find that while their reported net income was $100 million, their true owner earnings were only $20 million, or perhaps even negative. The company is an accounting success but an economic failure. The earnings season gambler focused solely on the headline EPS beat has just bought into a business that is furiously burning cash. They have mistaken the map for the territory and will eventually pay the price when the market realizes the cash isn't there. The path of the 99% is also paved with a dangerous reliance on simplistic metrics derived from net income. The most famous of these is the price-to-earnings, or PE ratio. This is the first valuation tool most people learn. They are told that a low PE means a stock is cheap, and a high PE means it's expensive. But this is a house built on a foundation of sand. If the E in the ratio, the earnings, is a manipulated, accounting-driven fiction, then the entire ratio is meaningless. A company can look incredibly cheap on a PE basis while being disastrously expensive from an owner earnings perspective. The classic examples are in capital-intensive industries like airlines, auto manufacturing, and heavy industry. These companies have enormous depreciation charges. In a good year, they might report a very high net income. Because their stock prices are often depressed due to the brutal nature of their industries, they can trade at a PE ratio of 5 or 6, looking like a bargain. The antithesis investor sees this low PE, thinks they've found a hidden gem, and buys in. What they fail to see is that to generate that income, the company had to spend an amount of cash on new planes or new factory equipment that was equal to, or even greater than, their depreciation charge. Their maintenance CapEx is enormous. When you run the numbers, you find their owner earnings are a tiny fraction of their net income, or are negative. The company isn't a bargain, it's a value trap. It's a business that has to run as fast as it can, spending billions of dollars just to stand still. The 99%, by trusting the flawed metric of net income, are systematically drawn to these types of capital-destroying businesses, wondering why their cheap stocks never seem to go up. They are ignoring the cardinal rule that Buffett's principle reveals: profit is an opinion, cash is a fact. And a business that doesn't generate cash for its owners is not a business at all, but a hobby. The profound difference between these two ways of thinking, focusing on net income versus focusing on owner earnings, is not merely academic. It manifests directly and powerfully in the financial reality of an investment portfolio, on the balance sheet of a company, and in the strategic decisions made by a CEO. The direct financial connection is the bridge between this abstract principle and tangible, measurable wealth. Let's start with the investment portfolio. An investor who uses net income as their primary guide will often find their portfolio cluttered with companies that are perpetually restructuring or investing for the future. These are code words for burning cash. They might own an airline that looks cheap on a PE basis, but every few years it needs to spend billions on a new fleet of aircraft, wiping out years of accumulated profits. The cash never makes it to the shareholder. It gets handed over to Boeing or Airbus. They might own a retailer that is constantly spending money to remodel its old, tired stores, a necessary expense just to keep customers from fleeing to competitors. This maintenance CapEx eats away at any cash the business generates. The portfolio of a net income-focused investor is often characterized by high activity, high drama, and low returns. It's a collection of businesses that are running on a treadmill, and the investor is running alongside them. Now, contrast this with the portfolio of an investor who has mastered the owner earnings concept. Their portfolio looks entirely different. It will be concentrated in businesses that are naturally capital light. Think of a company like Moody's, the credit rating agency. Their primary assets are their reputation and the trust of the market. They don't have giant factories that rust or a fleet of airplanes that age. Their maintenance capex is minuscule. Some office computers, maybe a server farm. As a result, almost all of their reported net income converts directly into owner earnings. The cash piles up. Or think of a software company with a dominant market position. Once the software is written, the cost to sell an additional copy is close to zero. The cash flow is immense. This is the financial connection. A focus on owner earnings naturally guides you towards businesses with superior economic characteristics. It acts as a filter, screening out the capital-intensive cash burners and highlighting the capital-light cash gushers. The result is a portfolio of businesses that don't just report profits, they produce mountains of spendable cash. This cash can then be used for three things that directly enrich you: the owner, paying a growing dividend, buying back its own stock, which increases your ownership percentage of the business, or reinvesting in high-return growth projects. A portfolio built on owner earnings is a portfolio designed for automatic, compounding wealth generation. This principle also revolutionizes how a CEO or entrepreneur manages their own business. A CEO focused on net income is incentivized to play accounting games. They might cut the research and development budget to boost quarterly earnings, sacrificing the long-term future for a short-term stock pop. They might engage in channel stuffing like Sunbeam to hit an arbitrary target. Their decision-making is distorted by the need to manage the accountant's opinion. A CEO with a CEO mindset focused on owner earnings behaves differently. They understand that their primary job is to maximize the long-term per-share intrinsic value of the business, which is a direct function of its future owner earnings. They will make decisions that might hurt net income in the short term, but will increase the cash-generating power of the business over the long term. They will invest heavily in a project with a high return on investment, even if it means higher expenses this year. They will obsess over capital allocation, asking with every dollar of retained cash, what is the highest return, most owner-friendly use for this money? This way of thinking transforms a business from a machine designed to produce reported earnings into a machine designed to produce cash for its shareholders. The financial consequence is a stronger balance sheet, a more resilient business model, and a stock price that, over time, will inevitably follow the upward trajectory of its owner earnings. This isn't just a stock-picking trick. It's a fundamental philosophy of business management that separates the truly great enterprises from the merely mediocre. The revelation of owner earnings did not come to Warren Buffett in a flash of divine insight. It was a slow, painful, and expensive education, forged in the gritty reality of the businesses he was buying. His journey is the foundational anecdote for this entire philosophy, a transformation from a quantitative, formula-driven investor into a qualitative business analyst. In the early days of his career, in the 1950s and 60s, Buffett was a strict disciple of his mentor, Benjamin Graham. He practiced what he later called cigar butt investing. He would look for companies that were statistically absurdly cheap. He'd scour financial manuals for businesses trading for less than the value of their working capital, meaning he was essentially getting the entire operating business for free. These were often terrible businesses, failing textile mills, struggling department stores, companies on the brink of obsolescence. But they were so cheap that he could buy them, wait for a small blip of good news, and then sell them for a modest profit. He described it as finding a discarded cigar butt on the street that had one free puff left in it. You could pick it up, take that final puff, and it was all profit. The problem, he discovered, was that you often ended up with a portfolio full of soggy, unpleasant cigar butts. These businesses rarely generated much cash and often required constant infusions of capital just to stay afloat. The turning point, the moment the seed of the owner earnings concept was planted, came in 1972 with the acquisition of See's Candies. On the surface, it was a deal that violated every rule of his old cigar butt style. Buffett and his partner, Charlie Munger, paid $25 million for the California-based candy company. This was a significant premium over its book value. To the old Buffett, this would have been unthinkable. He was paying for intangible assets like brand name and customer loyalty, things that didn't appear neatly on a balance sheet. But Munger had been pushing him to evolve his thinking, to understand that it was better to pay a fair price for a wonderful business than a wonderful price for a fair business. See's Candies was a wonderful business. It had a fanatically loyal customer base that allowed it to raise its prices year after year without losing business. It was a simple, understandable operation, but the true magic of See's, the element that would permanently alter Buffett's DNA as an investor, was its capital-light nature. The business was a cash-generating machine that required almost no capital reinvestment to grow. Think about it. To sell more candy, See's didn't need to build a massive new, multi-billion-dollar factory. It didn't need to engage in fantastically expensive research and development. It just needed to open a few more stores in shopping malls, which was a relatively minor expense. The company produced high profits, and crucially, those profits were not an accounting fiction. They were real cash that piled up in the bank account at the end of the year. The depreciation charges on their candy-making equipment were modest, and the maintenance capex required to keep the kitchens running was even more modest. As a result, the company's net income was a very close proxy for its true owner earnings. In fact, because of the way inflation worked, the cash generated was often more than the reported profit. Buffett was stunned by this economic reality. He had purchased a business that, after paying for all its expenses and the minimal upkeep it required, simply gushed cash. That cash could then be taken out of See's and redeployed into other investments by Buffett, funding the growth of his entire empire, Berkshire Hathaway. This experience was an epiphany. He realized that the real treasure was not a statistically cheap stock, but a business with excellent economics that produced surplus cash year after year. This insight led him, over the next decade, to formalize his thinking, culminating in his 1986 letter to Berkshire Hathaway shareholders. It was in this letter that he first explicitly defined owner earnings, giving a name to the powerful concept he had discovered through the sweet, profitable lesson of See's Candies. He was providing a tool to distinguish between the cigar butts and the See's Candies of the world, a tool that would become the cornerstone of his entire investment philosophy. The psychological power of focusing on a business like See's Candies goes deep into our innate understanding of ownership and effort. It taps into our deep-seated aversion to loss and our desire for a true endowment. Consider the psychological experience of owning two different types of businesses. The first is a capital-intensive airline. You have a great year, and the company reports $1 billion in net income. As an owner, you feel a sense of accomplishment. But then, the management team explains that to remain competitive, they need to order a new fleet of jets, which will cost $10 billion over the next 5 years. That $1 billion of profit you just made? It's already been spoken for. In fact, you're going to have to reinvest every penny of profit for the next decade just to replace your aging assets. This creates a constant feeling of running in place. It triggers a form of loss aversion. The profit never truly feels like yours, because it is immediately taken away to feed the beast of capital expenditures. You are on a treadmill, and the psychological burden is immense. Every dollar earned feels temporary, precarious, and already spent. The business feels less like an asset that serves you, and more like a demanding entity that you must constantly serve. Now contrast that with the psychological experience of owning a business like See's Candies or a modern equivalent like a dominant software company. The company earns $1 billion in profit. The management team explains that to maintain the business, they need to spend $50 million on new servers and office upkeep. After that, there is $950 million of cold, hard cash left over. This cash is unencumbered. It is truly yours, the owner's. It can be paid out to you as a dividend, used to buy back shares to make your stake more valuable, or used to acquire another cash-gushing business. This experience aligns with the endowment effect. The profit feels real, tangible, and permanent. It is a genuine addition to your wealth. The business is a true asset, a golden goose that lays cash eggs without demanding you build it a new golden nest every year. Buffett's focus on owner earnings is, at its core, a psychological filter designed to find businesses that provide the feeling of true ownership and avoid those that create the feeling of perpetual servitude. It's a method for avoiding the constant grinding anxiety of owning a business that consumes capital as fast as it generates it. It seeks out the psychological peace of mind that comes from owning an enterprise that is a net provider of cash, not a net consumer of it. This focus on the feel of ownership, the difference between a business that gives to you and one that takes from you, is a profound and often overlooked aspect of the value investing philosophy. It's about building a portfolio that doesn't just look good on paper, but one that feels like a fortress of financial security. To put this psychological preference into practice, we can build a mental model called the moat and the toll booth. This blueprint helps you categorize businesses based on their economic characteristics, ensuring you prioritize those that align with the owner earnings principle. It's a core component of developing a true CEO mindset, forcing you to think about the long-term structural advantages of a business, not its short-term earnings fluctuations. Step 1 of this model is to identify the company's moat. A moat, in Buffett's parlance, is a durable competitive advantage that protects a business from competitors, much like a moat protects a castle. Moats can come in several forms: a powerful brand name like Coca-Cola or Apple, a patent that protects a unique drug, a network effect like Facebook or Visa, where the service becomes more valuable as more people use it, or a low-cost advantage like Geico or Costco. Before you even look at the numbers, you must be able to clearly articulate, in simple language, what the company's moat is. If you cannot identify a strong, durable moat, the analysis should stop. A business without a moat is at the mercy of competition, and its long-term cash flows are inherently unreliable. Step 2 is to ask the crucial question that links the moat to the owner earnings concept. Is this a business that requires building a new castle every year, or is it a toll booth on a bridge? This is the heart of the mental model. A castle business is one that has a moat, but maintaining that moat requires massive, continuous capital expenditures. Think of a cutting-edge semiconductor company. It has a technology moat, but it must spend billions of dollars every year on new fabrication plants and R&D just to keep that edge. It is constantly rebuilding its castle to fend off invaders. An airline might have a moat in certain routes, but it must constantly buy new planes. These are difficult, capital-intensive businesses. A toll booth business, on the other hand, has a moat that is self-perpetuating and requires very little capital to maintain. Think of our See's Candies example. Its brand is the moat. Maintaining that brand requires making good candy and providing good service, not building new billion-dollar factories. Think of Moody's. Its reputation is the moat. Competitors can't easily replicate the market's trust, and Moody's doesn't need to spend much to maintain it. It's like owning a toll booth on an essential bridge. The traffic, revenue, comes every day, and your only real expense is a fresh coat of paint now and then. The cash just piles up. Step 3 of the model is to systematically prioritize the toll booths. When you are doing your stock analysis, you should actively screen for and give preference to companies that fit the toll booth description. This doesn't mean you can never invest in a castle business, but it does mean you must demand a much lower price for it to compensate you for the fact that a huge portion of its earnings will be consumed by maintenance capex. By applying this moat and the toll booth framework, you are operationalizing the owner earnings principle. You are building a qualitative filter that sits on top of your quantitative analysis. It forces you to look beyond the numbers on the page and to think deeply about the underlying economics of the business model. This is the difference between simple stock picking and sophisticated capital allocation. It's about recognizing that the best businesses are not just profitable, they are profitable in a way that is easy, durable, and generates an enormous amount of surplus cash for the people who own them. The antithesis to this disciplined, moat-focused approach is the growth-at-any-cost investor. This individual is a creature of narrative and excitement, seduced by the siren song of rapidly increasing revenues. They are fundamentally different from the earnings-season gambler, who is at least focused on a profit metric, albeit a flawed one. The growth-at-any-cost investor doesn't care about profit at all. They care about top-line growth, user growth, market share, any metric that suggests a company is getting bigger, faster. They willingly and enthusiastically buy into companies that are losing staggering amounts of money, believing that at some distant point in the future, the company will flip the switch and become profitable. This mindset was rampant during the dot-com bubble of the late 1990s and has seen a resurgence in recent years with certain high-flying technology and disruptor stocks. The core mistake of this investor is a profound confusion between activity and progress, between revenue and profit, and between a growing business and a valuable one. The airline industry serves as the classic, cautionary tale for this mindset. For decades, the airline industry has experienced phenomenal growth. More people are flying to more places than ever before. Revenue growth has been impressive. It is the quintessential growth industry. And yet, as Warren Buffett has famously quipped, if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville right. He would have saved his descendants a lot of money. Over its entire history, the airline industry as a whole has been a net destroyer of capital. The cumulative profits of all airlines since the dawn of aviation are negative. How is this possible? Because it is the ultimate castle business. The competition is brutal, forcing prices down. The unions are powerful, forcing costs up. And the capital requirements are astronomical. An airline's primary asset, its fleet of aircraft, is mind-bogglingly expensive and has a limited lifespan. They are in a constant state of spending billions upon billions of dollars just to maintain their current routes and level of service. Their maintenance capex is a ravenous monster that devours any cash they generate. The growth-at-any-cost investor sees the rising passenger numbers and growing revenues and gets excited. The owner-earnings investor sees the colossal capital expenditures required to generate that growth and runs in the opposite direction. They understand that it is possible for a business to grow itself into bankruptcy. This path of the 99% is not confined to old-line industries. It is equally prevalent in the technology sector. Many venture capital-backed startups are classic examples of the growth-at-any-cost model. They burn through cash to acquire customers, offering their service below cost to gain market share with the hope of one day achieving a dominant position. The investors in these companies are not looking at owner earnings. They are looking at user acquisition charts. They are betting on a story, a narrative of disruption. Sometimes, this works. A tiny fraction of these companies become the next Google or Amazon. But the vast majority fail. They run out of cash before they can ever reach profitability. The growth-at-any-cost investor, by ignoring the brutal reality of cash flow, is essentially buying a portfolio of lottery tickets. They are swinging for the fences every time, and while they may talk about their rare home runs, they are silent about the vast majority of their investments that strike out and go to zero. The owner-earnings philosophy is the direct opposite. It is not about hitting home runs. It is about consistently hitting singles and doubles, about owning businesses that are already profitable and gush cash today. It is a philosophy of financial prudence over speculative excitement, a strategy for getting rich slowly and surely, rather than trying to get rich quick and, more often than not, ending up poor. The owner-earnings calculation is the practical centerpiece of this entire philosophy. It's the moment we move from theory to action, from anecdote to application. While the concept is profound, the mechanics are surprisingly straightforward, though they require a bit of detective work. The formula, as Buffett laid it out, is owner earnings equals net income plus depreciation and amortization, maintenance capital expenditures. The first two components, net income and depreciation, are easy to find. They are clearly listed on a company's income statement and its statement of cash flows. The third component, maintenance capital expenditures, is the tricky one. It is the missing link that separates amateur analysis from professional-grade due diligence. Companies do not break out their capital expenditures into maintenance and growth categories. It's a number that you, the analyst, must estimate. This is where the art and science of investing truly meet. To illustrate this process, let's look at a company Buffett knows intimately, the Washington Post, which he first invested in back in 1973. At the time, newspapers were seen as a troubled industry, facing threats from television and rising costs. Many investors saw them as cigar butts. But Buffett saw something different. He saw a media monopoly. In most major cities, there was only one dominant newspaper. This gave them incredible pricing power, with both advertisers and readers. They had a deep moat. More importantly, he recognized its toll booth-like economic characteristics. A newspaper business, once it has its printing presses and distribution network established, does not require massive capital infusions to grow. Its main expense is ink and paper, which is an operating expense, not a capital one. To grow, it simply had to sell more ads and more papers, something its monopoly position made relatively easy. Let's imagine we are Buffett in the 1970s, analyzing the Post. We would start with its reported net income. Then, we would add back the significant depreciation charge for its massive printing presses. This gets us to a preliminary cash flow number. Now, for the crucial step, estimating maintenance CapEx. How would we do it? We would look at the company's total capital expenditures for the last several years from its cash flow statements. We would then read the annual reports, specifically the management's discussion and analysis section. We would be looking for clues. Is management talking about building a giant new printing facility to enter a new city? That would be growth CapEx. Or are they talking about replacing parts on the existing presses and buying new delivery trucks to replace the old ones? That is classic maintenance CapEx. Buffett's insight was that for a stable, dominant newspaper like the Post, the vast majority of its capital spending was simply maintenance. The amount needed to maintain the business was likely similar to, or even less than, its annual depreciation charge. By subtracting this conservative estimate of maintenance CapEx, he would have arrived at an owner earnings number that was significantly higher than the reported net income. He saw a cash gusher where others saw a struggling industry. This ability to look past the accounting figures and reconstruct a company's true cash-generating power was the secret to one of his greatest investments. He wasn't buying a newspaper. He was buying a cash machine that was on sale for a fraction of its true worth. The process of digging through financial statements to estimate maintenance CapEx can feel intimidating. It seems complex, and this is where a subtle but powerful psychological bias can creep in: complexity bias. Our minds have a tendency to equate complexity with sophistication. We often distrust simple solutions to complex problems, assuming that a valuable answer must be the result of a difficult and convoluted process. The owner earnings formula is deceptively simple. It has only 3 variables. This can lead some investors to dismiss it as too basic, preferring instead to get lost in a forest of dozens of different financial ratios, complex valuation models, and technical chart patterns. They believe that by mastering the complexity, they are gaining an edge. In reality, they are often just adding noise and distracting themselves from the one signal that truly matters. The genius of Warren Buffett and Charlie Munger is not their ability to handle complexity. It is their relentless, disciplined pursuit of simplicity. They have an almost allergic reaction to things they cannot understand. The owner earnings formula is the embodiment of this philosophy. It is a tool designed to cut through the immense complexity of GAAP accounting and the thousands of pages in an annual report to isolate the single most important variable, cash available to the owners. Overcoming the complexity bias means embracing this simplicity. It requires having the confidence to believe that the most powerful insights are often the most fundamental ones. It's about realizing that financial analysis is not an academic exercise in mastering obscurity. It's a practical exercise in finding reality. The reality of a business is not complex. It takes in cash, it spends cash, and what's left over is the profit. The owner earnings formula is the most direct and honest way to measure that simple reality. To fight this bias and make the calculation practical, we need a step-by-step mental model, a blueprint we can follow every time. Let's call it the Maintenance CapEx Detective. This is your instruction manual for finding the hidden number. Step 1. Gather your tools. You will need a company's annual reports, 10K filings, for the last 5 to 7 years. You are looking for consistency and trends, not a single data point. Step 2. Find the initial clues. In each 10K, go to the Statement of Cash Flows. Find two numbers, depreciation and amortization, and capital expenditures, sometimes called purchases of property, plant, and equipment. Write these down for each year. Step 3. Establish a baseline. For a company that is not growing, maintenance CapEx will, over time, be roughly equal to its depreciation charge. Depreciation is the accounting measure of assets being used up, and maintenance CapEx is the cash cost of replacing those assets. So depreciation is a decent starting point for your estimate. If a company's total CapEx is consistently far higher than its depreciation, it is likely spending a lot on growth. If the two numbers are close, the company is likely in a steady state, and most of its CapEx is for maintenance. Step 4. The Greenwald Method. This is a more advanced technique, pioneered by Columbia Business School professor Bruce Greenwald, for separating growth from maintenance. First, calculate the company's ratio of property, plant, and equipment, PP&E, to sales for the past 5 years. This tells you how many dollars of assets the company needs to support $1 of sales. Find the average of this ratio. Next, look at the increase in sales for the most recent year. Multiply that sales increase by the average PP&E to sales ratio you just calculated. The result is a reasonable estimate of how much the company had to spend on new assets to support that growth. This is your estimated growth CapEx. Finally, take the company's total capital expenditures for the year and subtract your estimated growth CapEx. What's left is your estimate for maintenance CapEx. Step 5. Apply the rule of conservatism. This is the most important step. Because this is an estimate, you want to err on the side of caution. When in doubt, overestimate maintenance CapEx. This will give you a lower, more conservative owner earnings number. If the company still looks like a bargain with this conservative figure, you have likely found a genuinely attractive investment. This detective-like process, moving from simple clues to advanced techniques and finishing with a dose of prudence, is the practical application of Buffett's wisdom. It transforms you from a passive reader of financial statements into an active investigator, relentlessly searching for the truth about a company's cash. The opposite of this diligent investigative approach is the path taken by the plug-and-play analyst. This person represents a huge segment of the retail investor population who crave a simple, automated answer. They don't want to do the detective work. They subscribe to a financial data service or a stock screening website, and they rely on the pre-packaged numbers it provides. Their favorite metric is usually free cash flow. On the surface, free cash flow seems very similar to owner earnings. The common formula is cash flow from operations minus total capital expenditures. It seems simple, clean, and logical. But it contains a fatal flaw. By subtracting total capital expenditures, it fails to distinguish between maintenance and growth spending. This single difference has enormous consequences for investment decisions. The plug-and-play analyst, using their pre-packaged free cash flow number, will be systematically biased against great, growing companies. Imagine a young, rapidly expanding company that is investing heavily to build new factories and capture market share. Its growth CapEx is huge. As a result, its free cash flow will look terrible, perhaps even negative. The screener will flag it as a poor-quality company. The plug-and-play analyst will dismiss it without a second thought. However, an owner earnings analyst would do the detective work. They would see that the company's maintenance CapEx is actually very low. They would calculate that its owner earnings are strong and growing, but the company is simply choosing to reinvest all of that cash into high-return growth projects. The owner earnings lens reveals a wonderful, compounding machine, while the lazy free cash flow lens sees only a cash-burning failure. Conversely, the free cash flow metric can make a stagnant, no-growth company look deceptively attractive. Consider a mature utility company. It's not expanding, so its growth CapEx is zero, Its total CapEx is therefore equal to its maintenance CapEx. In this specific case, and only in this case, free cash flow and owner earnings will be the same. The screener might pop this company out as a high cash flow business. The plug-and-play analyst might see it as a stable, attractive investment. But they are missing the bigger picture. The owner earnings philosophy is not just about finding cash flow. It's about finding businesses with attractive futures, with moats that can allow for profitable reinvestment of that cash. The lazy analyst sees a number. The diligent investor sees a business in its entirety. The disastrous consequence of this approach is a portfolio that is systematically tilted towards stagnant companies and away from dynamic, growing ones. The plug-and-play analyst will end up owning a collection of businesses that are cheap for a reason. Their best days are behind them. They will miss out on the next generation of great compounders because their chosen tool is too blunt to see the difference between spending money to grow and spending money just to survive. This is the price of convenience. The hard work of estimating maintenance CapEx is not optional. It is the very act that generates insight and creates a sustainable edge in the market. The ultimate purpose of calculating owner earnings is not just to perform a financial exercise. It's to have a superior tool for making real-world investment decisions. It is a litmus test that can instantly reveal the true economic health of a business, allowing you to compare companies on a level playing field. The best way to understand its power is through a tale of two companies. Let's compare a hypothetical heavy industrial company, American Steel, with a dominant consumer data company, Data Trust. In a given year, through a combination of a strong economy and favorable steel prices, American Steel might have a fantastic year. Let's say it reports a whopping $1 billion in net income. Data Trust, being a more stable but less cyclical business, also reports a very solid $1 billion in net income. To a novice investor looking only at the income statement or a simple P/E ratio, these two companies might appear equally profitable and equally attractive. They both earned $1 billion. Now let's apply the owner earnings litmus test. We start with American Steel. We take its $1 billion in net income. We look at its cash flow statement and see it has a massive depreciation charge of, say, $800 million, reflecting its enormous investment in blast furnaces, rolling mills, and heavy equipment. We add that back. Now we are at $1.8 billion in pre-capex cash flow. But then comes the crucial step. We investigate its capital expenditures. Steel mills are brutal, capital-intensive assets. They require constant, expensive upkeep and modernization just to remain competitive and meet environmental regulations. After careful analysis of its annual reports, we conservatively estimate its maintenance CapEx for the year was $900 million. So we take our $1.8 billion and subtract this $900 million. American Steel's true owner earnings are $900 million. A very respectable number, but already 10% less than its reported net income. Next, we turn to Data Trust. We start with its same $1 billion in net income. We look at its cash flow statement and see a very small depreciation charge, perhaps only $50 million. Its assets are mainly computer servers and office buildings, not giant industrial plants. We add that back, getting us to $1.05 billion. Now we investigate its capital expenditures. What does it take to maintain Data Trust's business? It needs to replace some servers, upgrade some software, and maintain its office space. A generous estimate for its maintenance CapEx might be $100 million. So, we take our $1.05 billion and subtract this $100 million. Data Trust's true owner earnings are $950 million. Now, let's compare. Both companies reported the exact same net income. But American Steel produced $900 million in real cash for its owners, while Data Trust produced $950 million. On a deeper level, the quality of these earnings is vastly different. To generate its $1 billion of accounting profit, American Steel had to spend a staggering $900 million in cash just to stay in the same place. Data Trust only had to spend $100 million. Data Trust is an infinitely more efficient, more elegant, and more valuable business. It is a true cash machine, while American Steel is a brutish, cash-hungry enterprise. The owner earnings calculation acted as a financial X-ray, allowing us to see past the surface-level similarity of their net income and view the profound difference in their economic skeletons. This is the power of the litmus test. It reveals which business is truly working for its owners. This analytical process is a powerful antidote to one of the most insidious psychological biases in investing, confirmation bias. This is our natural tendency to seek out and favor information that confirms our pre-existing beliefs or decisions, and to ignore information that contradicts them. Imagine an investor who, without doing deep due diligence, buys shares in American Steel simply because it looked cheap on a PE basis. Once they own the stock, their mind will actively start looking for reasons to justify that purchase. They'll pay close attention to news reports about rising steel demand. They'll latch onto a CEO's optimistic comments in an interview. They will build a narrative in their head that they made a brilliant, contrarian bet. When presented with the brutal reality of the company's maintenance CapEx requirements, their first instinct will be to dismiss it. It's uncomfortable information. It suggests they might have made a mistake. It threatens their self-image as a savvy investor. Confirmation bias will cause them to downplay the importance of capital spending, perhaps by telling themselves, "Oh, that's just a one-time thing," or "all industrial companies have to spend money." They will filter reality to fit their desired conclusion. The owner earnings calculation, when used as a prerequisite for investment, is a tool to break confirmation bias before it can take root. It forces you to confront the uncomfortable truths about a business up front. Before you get emotionally and financially committed to a stock, you must look at the cold, hard numbers of its cash-generating ability. The calculation doesn't care about your story. It doesn't care about the CEO's charisma. It is an objective, pre-commitment device. If the owner earnings number is weak, it sends up a massive red flag that you cannot ignore. It forces you to ask the hard questions before you click the buy button. Why is this company's reported profit so much higher than its cash profit? Is this a capital-intensive treadmill I'm about to step on? By making this calculation a non-negotiable part of your stock analysis process, you are building a psychological circuit breaker into your decision-making. You are creating a system that prioritizes objective reality over subjective narrative, protecting you from your own worst enemy, the powerful innate desire to be right, even when the facts show you are wrong. To operationalize this comparative analysis, we can create a simple but powerful mental model called the Cash Conversion Scorecard. This blueprint allows you to quickly and effectively compare different companies and even entire industries based on their efficiency at turning accounting profit into real cash for owners. It's a high-level due diligence tool that can be the first screen you apply to any potential investment. Step 1 is to gather your targets. Select 2 or more companies you wish to compare, ideally within the same industry to start, but also across different industries to understand their fundamental economic differences. For each company, you will perform the same set of calculations. Step 2 is to calculate the 2 key profit figures for each company for the last several years: net income and owner earnings. This is the raw data for your scorecard. You've already learned how to perform the detective work to find these numbers. Step 3 is the core of the model. Calculate the cash conversion ratio. The formula is simple: owner earnings divided by net income. This single ratio tells you a powerful story. If the ratio is greater than 100%, it means the company's real cash profit is actually higher than its reported accounting profit. This is the hallmark of a truly exceptional business, often one with large non-cash charges and very low maintenance CapEx. If the ratio is close to 100%, you have a very high-quality, efficient business that accurately reports its reality. If the ratio is significantly less than 100%, you have found a capital-intensive business. The lower the ratio, the more of the company's profit is being consumed just to stay in business. A ratio below 50% is a major red flag. Step 4 is to compare the ratios. Lay out the cash conversion ratios for your target companies side by side. The comparison will be stark and immediate. You will instantly see which business is a superior cash converter. A company with a consistent ratio of 95% is fundamentally a better business than one with a consistent ratio of 60%, even if their growth rates or PE ratios look similar. This scorecard provides a single, powerful number that cuts through the noise. It should be a primary factor in your decision-making, guiding your capital towards businesses that work efficiently for their owners, and away from those that work hard just to survive. The antithesis of this granular, business-focused analysis is the sector-based investor. This person thinks in broad, blurry categories. Their investment thesis is not, "I want to own this specific wonderful business," but rather, "I believe the technology sector is going to do well," or "I want exposure to the industrial recovery." They then proceed to buy an ETF that tracks the sector, or they pick a few of the largest and most well-known companies within that sector, often based on simplistic metrics or name recognition. They are buying the neighborhood without ever looking inside the houses. The fundamental flaw in this approach is that it assumes all companies in a sector share the same economic characteristics. This is rarely, if ever, true. Every sector contains a mix of wonderful businesses, mediocre businesses, and terrible businesses. The technology sector contains both capital-light software giants and capital-intensive hardware manufacturers. The industrial sector contains both brilliant niche manufacturers with high returns on capital and commodity producers that are in a constant, brutal struggle for survival. The sector-based investor, by buying the whole basket, is guaranteeing that they will own the bad along with the good. They are diversifying away their ability to generate exceptional returns by averaging down to the mediocrity of the sector as a whole. The owner earnings calculation and the cash conversion scorecard are the tools that allow you to dissect a sector and separate the wheat from the chaff. They enable you to perform high-grade due diligence that the average investor simply won't do. While the sector-based investor is buying an industrial ETF, you are analyzing the individual companies within it. You are discovering that one company has a cash conversion ratio of 85% due to a proprietary manufacturing process and a strong brand, while its larger, more famous competitor has a ratio of 40% because it's in a more commoditized end of the market. This is the source of alpha of beating the market. It comes from doing the work that others are unwilling or unable to do. It comes from understanding that you are not buying a sector, you are buying a fractional ownership stake in a specific individual business. Your job as an investor is to select the very best businesses, not to get a blurry, averaged-out exposure to an entire industry. The path of the 99% is to think in generalities. The path to superior portfolio growth is to think in specifics, armed with the precise, illuminating tool of owner earnings. Ultimately, the mastery of this principle is not just about a single calculation. It's about a complete strategic integration of this idea into a coherent investment philosophy. It's about how this one concept changes everything you do, from how you value a company to the type of businesses you want to own for the long term. There is no better final anecdote to illustrate this full integration than Warren Buffett's monumental investment in Apple. For decades, Buffett famously avoided technology stocks. He often said he didn't invest in things he couldn't understand. So when Berkshire Hathaway began accumulating a massive stake in Apple starting in 2016, many were stunned. They saw it as a violation of his own principles. They thought he was too late, that he was chasing a hot stock, or that he was investing outside his circle of competence. But they were wrong. They were looking at Apple with the old lens, seeing it as a complex and fickle technology company. Buffett was looking at it through his perfected owner earnings lens, and he saw something entirely different. He saw the ultimate consumer monopoly. He saw a supercharged See's Candies. He didn't see a company that sold phones. He saw a company that owned a non-negotiable piece of real estate in the minds and lives of over 1 billion people. The iPhone was not just a product, it was the hub of modern life, an ecosystem of apps, payments, and services that was incredibly sticky. The brand was a moat of unimaginable width and depth, but it was the financial characteristics that sealed the deal. Buffett would have looked at Apple's financial statements and seen a sight to behold. Yes, the net income was astronomical, but he would have gone deeper. He would have added back the depreciation. Then, he would have analyzed their capital expenditures. While Apple does spend billions on manufacturing tools and data centers, that spending is remarkably small relative to its enormous earnings. He would have performed his maintenance CapEx calculation and arrived at an owner earnings figure that was almost beyond belief. He saw a business that was generating a torrent of cash, a river of money so vast that the company literally could not find enough ways to reinvest it all. This was the ultimate toll booth. The cash just piled up, quarter after quarter, year after year. He wasn't betting on the next iPhone model. He was buying the ecosystem, the brand, the toll booth, and most importantly, the torrential, undeniable, and ever-growing stream of owner earnings. The Apple investment was not a departure from his philosophy. It was the ultimate culmination of it. It was the seize candies lesson applied on a world-changing scale. The psychological shift that occurs when you adopt this philosophy is profound. It fundamentally alters your time horizon by overcoming the powerful bias of myopia, our natural tendency to focus on the present at the expense of the future. The entire financial media ecosystem is designed to promote this myopia. It operates on a cycle of quarterly earnings reports, daily stock price movements, and minute-by-minute breaking news. An investor focused on net income is trapped in this cycle. They are perpetually anxious about the next quarterly beat or miss. Their emotional state is tied to the short-term fluctuations of the market. They are playing a trader's game, a game of predicting near-term sentiment. Focusing on owner earnings is a declaration of independence from this madness. The calculation itself requires you to look at years of data, to think about the long-term capital needs of a business. It forces you to stop thinking like a trader and start thinking like a business owner who plans to hold the asset for 10, 20, or 30 years. Your primary question is no longer what will this stock do next quarter, but how much cash is this business likely to generate for me over the next decade? This shift in perspective is liberating. You are no longer a slave to the market's manic depressive swings. A sudden market crash is no longer a source of panic. It's an opportunity to buy more of a wonderful cash-producing business at a discount. This long-term mindset, this immunity to short-term noise, is perhaps the greatest psychological advantage an investor can possess. It is the bedrock of the patience required for true wealth compounding. To fully integrate this way of thinking into a repeatable process, we can use a final mental model, the compounding machine checklist. This is the ultimate blueprint, the filter through which any potential long-term investment must pass. It combines the owner earnings calculation with the qualitative factors that ensure durability. Before you invest a single dollar, the target company must receive a yes on all 4 of these questions. Question 1. Does the company have a long history of consistently positive and, ideally, growing owner earnings? This is the core quantitative test. You are not looking for a one-year fluke. You are looking for a proven, multi-year track record of generating real cash for shareholders. This demonstrates the underlying health and profitability of the business model. Question 2. Does the management team have a history of intelligently allocating that cash? It's not enough for a business to generate cash. It must use that cash wisely. You need to read the CEO's letters to shareholders. Look at their track record. Do they reinvest the cash in projects that earn high rates of return? Do they buy back stock when it is undervalued? Do they pay a sensible dividend? Or do they squander the cash on foolish, empire-building acquisitions that destroy value? A great business with poor capital allocators at the helm will not be a great investment. Question 3. Does the business possess a durable competitive advantage, a wide moat that will protect those future owner earnings? This is the qualitative check that ensures the future looks as good as the past. You must be able to articulate the source of the company's moat, brand, network effect, switching costs, or cost advantage. You must have a reason to believe that this moat will still be intact 10 or 20 years from now. A company with great current owner earnings but no moat is vulnerable to competition that can erode those profits over time. Question 4. Is the current stock price a reasonable multiple of its owner earnings? This is the final valuation check. Even the best business in the world can be a bad investment if you pay too high a price for it. Instead of using a flawed P/E ratio, you should calculate a price-to-owner earnings (POE) ratio. By comparing this ratio to the company's historical levels and to other high-quality businesses, you can determine if you are being offered an attractive entry point. A company that passes all 4 of these checks is a true compounding machine. It is a business that is not only profitable today, but is structured to become more valuable over time, and it is available at a price that offers a margin of safety. This checklist is the culmination of our entire journey. It is the strategic framework that turns the principle of owner earnings into a comprehensive, world-class investment philosophy. The antithesis of this disciplined, business-like approach is quite simply the gambler. This individual is not an investor in any meaningful sense of the word. They do not engage in financial analysis. They do not read financial statements. They do not think in terms of business ownership. For them, the stock market is a casino. They chase stories, memes, and speculative frenzies. Their decisions are driven by hype, social media trends, and the fear of missing out. They buy a stock because a celebrity mentioned it, or because it's involved in a revolutionary new technology they don't really understand, or simply because the price is going up very fast. Their portfolio, if you can call it that, is a chaotic and incoherent collection of lottery tickets. They have no thesis for why any of their holdings should be worth more in the future, other than the vague hope that someone else, a greater fool, will come along and pay a higher price. The gambler's experience is one of extreme emotional volatility. They feel euphoric during bubbles and utterly crushed during crashes. They are perpetually glued to the screen, their mood dictated by the meaningless red and green flickers of the stock ticker. The contrast with the owner earnings investor could not be more stark. The investor is calm, methodical, and detached. Their process is repeatable and grounded in business reality. Their decisions are based on a conservative calculation of cash flow, not on the wild emotions of the crowd. Over any meaningful period of time, the outcomes of these 2 approaches are not a matter of luck. They are a matter of design. The gambler's path almost inevitably leads to ruin. The path of the owner earnings investor, followed with discipline and patience, leads to the quiet, inexorable accumulation of real wealth. And this is the final, most direct financial connection. The relentless focus on owner earnings is the most reliable path to achieving genuine financial freedom. The ultimate goal of investing is not to beat the market or to get rich quick. It is to build a portfolio of assets that produces a stream of cash, a stream that grows over time and will eventually be sufficient to cover your living expenses, freeing you from the need to trade your time for money. Owner earnings is the metric that finds those assets. When you consistently invest in businesses that generate a surplus of cash, companies with high and rising owner earnings, you are acquiring shares in entities that are designed to pay you. The cash they produce must go somewhere. It will be returned to you in the form of dividends, which you can spend or reinvest. Or it will be used to buy back shares, which increases your ownership stake in the business and makes each of your shares more valuable and entitled to a larger piece of future profits. Or it will be reinvested by a skilled management team into new projects that will generate even more owner earnings in the future, creating a virtuous cycle of compounding growth. This is the end game. This is what wealth management is all about. You are slowly, deliberately, and rationally building your own personal money machine. Each share you buy in a high-quality cash-producing business is another gear in that machine. The principle of owner earnings is simply the design manual, the blueprint that shows you how to find the highest quality gears and assemble them into a powerful, durable, and ever-growing engine of personal financial freedom. You have made it to the end, and in doing so you have invested something far more valuable than money. You have invested your time and your attention. That investment has now paid its first dividend. You no longer have to blindly trust the profit numbers you see in the headlines. You no longer have to be a passive consumer of the financial media's narratives. You now possess the lens of owner earnings, the intellectual tool to cut through the accounting fog and see the true cash heart of any business. You have the ability to differentiate between a company that is merely an accounting success and one that is a genuine economic machine. This skill is your permanent defense against corporate hype and financial manipulation. It is the first and most critical step in transitioning from a speculator to a true business owner. But this powerful calculation, this ability to find a company's true profit, is just one crucial node in a much larger, interconnected network of mental models that the world's greatest investors use. Knowing what a company earns today is step one, but the far more important questions remain. How do you know if that profit is *durable, NOP? How can you be confident that competitors won't erode those earnings over the next 10 or 20 years? The calculation of owner earnings tells you the size of the cash flow stream, but it doesn't tell you about the strength of the moat that protects that stream. A profitable business without a moat is a castle built on sand, vulnerable to the ceaseless tides of competition. The video that is now appearing on your screen was designed to be the next piece of that map. It is the logical next step in your education as a capital allocator. It directly addresses this critical question of competitive advantage. It deconstructs the different types of economic moats that exist and provides a framework for how to identify them, how to assess their durability, and how to avoid the common mistake of seeing a moat where none exists. It is the essential link that connects the question of what a company earns to the far more important question of how long can it keep earning it. For many, simply learning the owner earnings calculation is enough. It's a massive leap forward. But for those who are truly serious about building lasting, generational wealth, for those who see themselves not as retail investors but as future capital allocators and business owners, the journey must continue. Understanding the numbers is only half the battle. Understanding the business is the war. The next step in completing your mental arsenal, in building an unshakable foundation for your financial future, is just one click away. Continue your ascent.